You did everything right, and you still can't afford a house. The U.S. housing market just posted its lowest transaction volume since 1995, and home prices are at all-time highs. At the same time, fewer buyers, higher prices. That defies every principle of supply and demand, and yet here we are. If you've tried to buy recently, you already know something is deeply wrong. You just can't put your finger on what. By the end of this video, you will. Every domino, in order, with the actual numbers, and exactly what it means for your next move. Median home price today, over $400,000. In 2019, it was $272,000. That's a 46% jump. Not in a coastal market, nationally, the dead middle of the country. Mortgage rates sit around 6.4 to 6.5%. In January 2021, you could lock in at 2.65%. That's not a small spread. It's a completely different cost structure. Same house, $400,000 purchase price, 20% down. At 2.65%, $1,293 a month. At 6.5%, $2,023 a month. $730 more every single month for 30 years. That's over $250,000 in additional interest on the exact same house. And that house itself cost $146,000 more than it did 6 years ago. You're not just paying more for the loan, you're paying more for the asset. At the same time, this isn't bad luck. It's the compounded output of 3 overlapping structural shocks. Let's go through them. Shock 1, 2020. The Fed cuts rates to zero and starts buying $120 billion per month in bonds and mortgage-backed securities. By January 2021, the 30-year fixed hits 2.65%, the lowest since 1971. Demand explodes. COVID amplifies it. Remote work jumps from under 6 to over 18%, practically overnight. Millions of workers realize their income is location independent and leave. Manhattan sheds 200,000 households. San Francisco, Chicago, and LA lose tens of thousands. All of them flood into Austin, Phoenix, Boise, Nashville, cities with thin inventory not built to absorb that kind of demand. National prices up 37% in 24 months. Austin up 61, Phoenix up 59, Boise up 53. Buying in 2020 or 2021 was one of the best financial decisions millions of Americans ever made, almost entirely by accident. That's not skill, that's timing. And for everyone who wasn't positioned to buy during that window, what came next was worse. Shock 2. Inflation hits 9.1% by mid-2022, a 40-year high. The Fed responds with 11 hikes in 16 months, from 0.25 to 5.5%, the fastest tightening cycle in 4 decades. Mortgage rates follow hard. January 2022, 3.22%. October 2022, 7.08%. October 2023, 7.79%, the highest since 2000. At 7.79%, that $320,000 mortgage costs $363,000 more over the loan term than it did at the pandemic low. To qualify for the median home at today's rates, you need $106,000 in household income. The median is $83,700. Every quarter-point hike knocked roughly 1.4 million buyers out of the market entirely. Home sales fell from 6.12 million in 2021 to just over 4 million by 2025. We are selling fewer homes today, in a country with 100 million more people than 1995 than we sold in 1995. And prices didn't fall. Demand collapsed and supply collapsed at the same time. Which brings us to the most underreported piece of this story. Shock 3, the lock-in effect. And this is the one that's quietly holding the entire market hostage. 51% of all outstanding US mortgages carry a rate below 4%. About 20% are below 3%. If you locked in at 2.75% in 2021, you hold a financial instrument that no longer exists, and no bank will recreate it. Sell today, and you're not just moving, you're permanently surrendering the cheapest debt you'll ever access in your lifetime, and replacing it with debt that costs twice as much. That rate swap costs $730 more per month, every month for 30 years. That's $87,600 over a decade, in interest alone, just for wanting to live somewhere different. The Atlanta Fed found this effect reduces the probability of any homeowner listing their home by 21 to 23%. FHFA estimates it wiped out 1.7 million transactions that would otherwise have happened. Active inventory is still 17% below 2019 levels. Months of supply, 3.3 to 3.8. A balanced market needs 6. The market isn't broken because it's collapsing. It's broken because it has completely stopped moving. Now let's talk about who's actually getting squeezed the hardest. Run the numbers on someone doing everything right. Healthcare administrator, $74,000 income, above the national median, no consumer debt, 760 credit score, $31,000 saved over 3 years of real sacrifice. Median home in her market, $385,000, 10% down. $346,500 loan at 6.5%. Monthly principal and interest, $2,190. Add taxes, insurance, and a maintenance reserve. Total monthly cost, $3,010. She takes home $4,650 a month. Housing eats 65% of it. $1,640 left for everything else. She cannot afford this house. Not because of anything she did wrong, because the qualifying income for this home is $110,000 and she earns $74,000. That $36,000 gap is structural. It's baked into the math. And there are millions of people in exactly this position, qualified by any historical standard, excluded by the current one. The data confirms it. First-time buyers are just 21% of all purchases, a 44-year record low. The historical norm is 40. According to NAR, the median first-time buyer age is now 40 years old. In the early 90s, it was 28. Buying a decade later costs roughly $150,000 in foregone lifetime equity. 22% of millennials have abandoned homeownership as a goal entirely. Not paused it, abandoned it. Meanwhile, baby boomers represent 42% of all buyers, and half of older boomers are buying entirely in cash. They sold a house they bought for $200,000 in 1998 that's now worth $700,000. They walked in with no mortgage dependency, while the 32-year-old is trying to win a bidding war with a pre-approval and $31,000 saved. Every institution with a financial stake in your decision has a structural incentive to tell you now is a great time to buy. None of them make money when you say no. Here's what almost never gets airtime. The inventory shortage didn't start in 2020. It was built over 15 years of underbuilding after the 2008 financial crisis. After the crash, builders pulled back hard. Housing starts averaged 990,000 units per year through the entire 2010s, against a historical baseline of 1.5 million. And what got built skewed heavily toward the high end, because that's where the margins are. Entry-level homes under 1,400 square feet, over 400,000 per year in the 1970s. Just 65,000 in 2020, an 80% decline. The starter home, the traditional first rung on the wealth building ladder, was effectively discontinued as a product. Then came the pandemic surge, then the rate shock, and now tariffs. Steel up 50%, aluminum up 50%, Canadian lumber up 45%, adding $10,000 to $17,500 to the construction cost of every new home. Freddie Mac estimates a shortage of 3.7 million units. No executive order, no policy package, no rate cut builds 3.7 million homes in 2 years. So if supply is the long game, what does the short game look like? Is any of this about to collapse? Someone always asks, is this 2008? No, and the reasons matter more than you think. In 2006 and 2007, subprime mortgages were 18 to 21% of all originations. Liar loans, interest-only products, borrowed leverage against invented valuations. The system had zero margin for error. Today, subprime is under 4%. Median origination credit score is 758, 50 points higher than 2006. Just 2.2% of mortgages are underwater versus 26% in 2009. Homeowners hold $35.8 trillion in collective equity. The 2008 crisis happened because banks lent money to people who couldn't repay it against valuations they largely invented. Today's problem is almost the inverse. The lending is sound, the equity is real, and median earners still can't afford entry. Progress, technically. A crash at least creates buying opportunities. A frozen market just keeps absorbing income and waits for time to do what policy can't. So when does this end? Everyone's pointing at rates, and they're not wrong, but the answer is more complicated than you think. Because here's the counterintuitive risk almost nobody is modeling. 37% of homeowners say they won't consider selling until rates fall below 5%. That threshold isn't close. The lock-in effect does unwind gradually. People change jobs, get divorced, retire. The share of sub 4% mortgages has already fallen from 65 to 48%. That slow release is the most credible path forward. But slow is the operative word. This is a 5 to 10 year process. A fast, sharp rate drop could temporarily worsen affordability. Millions of sideline buyers re-enter overnight. Supply doesn't recover overnight. Massive demand into a 3.7 million unit deficit equals one outcome. Prices spike again. Same dynamic as 2020 to 2022, at a higher baseline. The cure administered too fast could accelerate the disease. The honest base case? Prices move roughly sideways for years while incomes gradually close the gap. No crash, no dramatic recovery. Slow, grinding adjustment with persistent affordability pressure at the median. So here's how to think about the decision. You're not misreading the market. The $22,000 income gap is structural. It's in the math before you even open Zillow. Buy if total monthly housing costs stay below 28 to 30% of gross income, and you plan to hold for at least 7 years. If the math fails at that threshold, it fails. Stretching to 40 or 45% of income because your agent says it's a great time is not a financial strategy. Renting and investing the difference is a completely legitimate wealth strategy in a high-rate, high-price environment. It can match or beat the risk-adjusted return of buying an overpriced asset. Nobody earns a commission when you put money in an index fund, which is exactly why nobody with a financial stake in your decision will ever suggest it. If you are buying, look seriously at new construction. Builder rate buydowns to 4.5 to 5% are real. Just verify the incentives aren't masking an inflated base price. Run every number. The error isn't renting. The error is buying any asset at any price and assuming appreciation bails out bad underwriting. In this market, that assumption is a liability. You're not failing at adulthood. The math is broken. Now you know exactly why and what to do about it. If this was useful, hit like. It genuinely helps the channel. And if you want the next step, what this means for your actual portfolio, that video is already waiting.